Well, maybe our most popular parlor game, talking about house prices. For the last few years, the talk has centered on whether or not they're about to crash. Tonight, we've convened the bottom line to answer your questions, and you sent some really good ones. Patty Croft is an economic analyst and former senior banker. Jim Stanford is an economist with Unifor. Preet Banerjee is a personal finance advisor and freelance journalist. And Amanda Lang is our senior business correspondent. Their answers in a moment, but first some basics. Sure, what goes up must come down, but for years it's been all about up. Even with a shaky economy, house sales just keep humming along. Another 2.7% in the last year. And prices, they're up too, 6% to a whopping national average of $430,000. That's even with Alberta's market slumping and the prairies weak. But the major driver remains the hotspots of Vancouver and Toronto, and they are still hot, very hot. So whatever happened to the much-discussed big bubble and the predicted burst?
When the bubble bursts.
In a housing bubble.
People talk about the bubble.
We are in a significant bubble.
What actually a bubble is.
Concerned about the bubble.
We're still waiting. Interest rates are part of the reason they remain historically low and so tempting for buyers. And even with dire warnings from almost every corner, the Minister of Finance said this just the other week.
There is no housing bubble.
But that hasn't stopped the headlines. So what about the value of your home, your condo, your mortgage? When to buy, when to sell, when to rent? Is there really a bubble? It's time for your questions. Let's get to the answers. Let's get to the first question. Here it is, came in on video. Watch this.
Hi, my name is Laura Medeiros, and my question for the bottom line is, how much of the housing market is foreign investment, and what is the percent increase as a result of that foreign investment?
You know, we get this question all the time, right? How much of all this is foreign investment? Patty, what's the answer?
You know, I'd love to be able to answer that with cold, hard facts, but there aren't any. There's no comprehensive surveys to collect the data. But most analysis suggests that about 5% of the demand of the total Canadian market is related to foreign investment. But it varies by region and by type of property. So, for example, in Vancouver, in luxury housing, about 40% of that is driven by foreign investment.
Amanda?
Patty's right. We don't know, and experts will say that nobody measures it. Foreign investors actually often buy through a local Canadian corporation, so it's hard to track. The only thing I would say is it's not necessarily a bad thing because the type of foreign investment matters. And these days, there's a lot of foreign capital looking for a hard asset because interest rates are low. They want some kind of safe place for money, and that's patient capital. So that actually may be a better form of investor than your next door neighbor who's buying a condo hoping to make money on it.
All right, next question from Twitter. John Dobbin from Winnipeg writes, should I, as a condo owner, look to sell even if there is a mortgage penalty, all this to avoid later devaluation? Preet.
Two parts to that question. First, how big is the mortgage penalty? And these vary wildly. I saw a mortgage broker tweet the other day that someone with a $900,000 mortgage had a $10,000 penalty, and someone with a $600,000 mortgage had a $34,000 penalty. So that's part one. The second part is, how confident are you that you can time the market? A lot of people have been trying to time the market with not a lot of success. So I would frame it as, how upset would you be if you were wrong?
Jim.
The other piece that isn't in the question is why he wants to sell. I mean, if he's selling because he has to move somewhere, then obviously, you just have to bite it.
Sounds like he's selling, or is thinking of selling, simply to
try and lock in the gains.
Exactly.
And he is trying to time the market, and it is a risky business. I prefer to think of your house as a place to live in. And in that regard, if he's moving, then yes, he has to take it.
All right, next question. And this one comes from Nancy Rawson in Hunter River, PEI. Sounds like a great place. Why would anyone use a realtor to sell their home when you can do it yourself and save thousands? By selling myself, I can pass along financial savings to prospective buyers, keeping me competitive in the marketplace. Preet.
I hear this question a lot lately because if you sell a $500,000 home and a 5% realtor commission, that's $25,000. You sell in a market where it sells in a day, you kind of ask, well, what did I pay for? It's the prospective buyers. So when you look at it, a real estate agent's commission is split between the selling agent and the buying agent. So if there's no commission to split, the buying agents aren't going to show their clients your house. So you have to do a lot more lead work. So you could do it, or you could bite the bullet, get a realtor, and maybe get a quicker sale.
All right. Next question of yours comes on video.
Hi, I'm Jamie Harbinson from Ottawa. I'm 48 years old and married, and we're mortgage free. For years, my RRSP lost money, and I'd like to look at investing in real estate to help boost my retirement years. The problem is that I'd have to take out a mortgage on my house to get the down payment. With interest rates being historically low, I think it's a never-before-seen opportunity, but my wife doesn't like the idea of having a mortgage again. What are your thoughts?
Oh, Patty.
Who's waiting
Patty,
into
you're
this
going to
one?
have to settle this family discussion here.
I'm going to side with the wife. No, 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 don't do that. It makes the hair on the back of my neck stand up when I hear people talk about borrowing money, using leverage to pay for something to fund their retirement. This gentleman is only 48 years old. You're young. You and your wife can work, sock away that money, and you had bad luck with your RSP in the past, but get a fee for service advisor to put you into some conservative investments at low fees, and that'll solve your retirement problem. But do not borrow money to fund your retirement.
One for the wife on that one. All right, another video. Here it is.
Hi, my name is Michael Delacosta from Calgary. I'm in my late 30s, unmarried, and have never owned property. With no mortgage, I have no credit card or loan debt, modest savings, and retirement plans. When I hear reports of Canadians owing 162.6% of their annual income to debt, I don't feel owning property is a good decision. Am I wrong?
Amanda.
Well, I mean, I've said this before. The reason to buy a home is to have a place that you can only buy. In other words, the place you want to live is the only way to get it. Renting is fine, but the caveat is, will you force yourself to save? So renting is perfect as long as you have a savings plan that you're committed to. Most people actually benefit from a home because it forces them to build up equity over time. If you're willing to actually make that commitment, go ahead and rent.
He sounds like he's making that commitment.
Then, good for him, and no rush. And by the way, he may actually time the market beautifully, and when he's ready to buy, prices may have come down.
He's got to see Preet's video. Preet's got this awesome video on YouTube that explains that renting versus buying thing. Google Preet's video on that. It is exactly the right answer, as Amanda gave. Yes,
and it's free, right?
Yeah, I'll put the link on the national Facebook page.
Yeah. Oh, okay, good. Here's another one. Comes in from Mark and Lisa Revel in Toronto. My husband and I both live and work in Toronto. We currently rent a condo and would like to buy a house. We each earn $55,000 to $60,000 a year. First, can we afford a small house in Toronto on our income? Combined income, 120 grand, asking whether they can afford a house. Second, should we wait to see if house prices go down, or is that just wishful thinking? Thank you. Jim.
Well, the headlines the other day was the average detached house in Toronto was $1 million. Yeah. So, you know, I guess you could buy a small house. They probably mean a really small house. Let's say you bought half a house, $500,000. That could be out in the suburbs further, or just a very small place. The mortgage and fees and so on monthly today is probably going to run you $2,300 a month or up. So you probably can afford that out of that combined income of those two spouses. But they've got to make sure, number one, as we've all been saying, it's a place that they want to live in. Number two, stress test your budget, because the interest rates are going to go up somewhere. We don't know when. But when they go up, make sure that you've got room in your budget for, say, $3,000 a month in mortgage fees. Most of all, make sure this suits your lifestyle. Don't think of it as an investment. Again, think of it as a place to live and raise your family.
Preet, what do you think?
Yeah, there's no shortage of calculators out there that can help people do that. There's a great website called ratehub.ca, and they've got a number of affordability calculators, mortgage, budgeting calculators. And what I would do is I would take a look at what they could afford and see what that monthly payment is, compare that to their current rent, and the difference, save that diligently into a savings account to build up to their down payment. And then they can also see if they can afford it or if they're going to tap into it or not.
It still seems so, bizarre, a statement of our times,
right,
that a family making $120,000 a year is wondering whether they can afford a house. Back to the video.
Housing bubble? What housing bubble? Economics 101 would suggest that in a free market, properties are worth what someone is willing to pay for them, just like for vehicles or other assets. Since properties keep selling and people keep buying them, including with offshore and new immigrant money, doesn't that suggest that the bubble is a myth at this time?
Now, this is the guy who was giving Joe Oliver, his advice on the no bubble. No, but he makes an argument. What do you make of it?
Well, so the only thing I would say, and I don't mean to be dismissive, but if you said if there's a willing buyer at any price, I'll take you back to Holland and sell you a tulip bulb way over market. So bubbles happen. People get excited and they get they give inflated values to assets. Harder to do with some assets than others. We know historically it happens with real estate. So I would say be cautious. I'm not saying there is a bubble. I'm not sure that there is, but I would say be cautious because when there is one, the correction can be severe.
So you're hedging your bubble bets.
Yes.
Patty.
Well, I think the questioner assumes that markets are efficient and people are rational, but in a bubble, what you get is irrational exuberance. So people extend the price trend and think it's going to go on forever. We saw it with tulip bulbs. We saw it with .com. We've seen this movie many times before. But I think the other thing about bubbles, Peter, is they're very obvious with 20/20 hindsight. So once it bursts, then everybody says, oh, that was clearly a bubble. So I think we have to listen to that. But the other thing is that right now, lots of people outside of Canada are saying we have a bubble. But inside Canada, the consensus amongst bank economists anyway is it's not a bubble. It's overvalued by maybe 5 to 10%. So we'll see ultimately who's right. And maybe that's cold comfort. I'm not sure.
All right, another video. Here we go.
This is Joel Gunther from Oshawa, Ontario. We hear a lot of talk about the general fear that we're living beyond our means. Do you think it's a bad idea to pay out other debts by adding to your mortgage? Thank you.
All right. Who wants that one?
I'll take it.
Free. Go for it.
Yeah, it's a great question. I mean, consolidating your debt by taking high interest debt and rolling it up into the lower interest mortgage makes sense mathematically. The problem is, if the people who do that, there's a high rate of failure. And what I mean by that is now they've got access to more credit on their credit cards. And if they get into the same pattern, this starts a very vicious cycle. So if you can truly change your behavior, then yes, it makes sense. But if not, and you have to be honest with yourself, it's a recipe for disaster.
All right. Here's one from Gus Watson in Vancouver. For you, Amanda. Home ownership is a retirement nest egg for many Canadians. Recognizing that we have the baby boom cohort moving its way through retirement years, birth rates below replacement level, low immigration rates, and overall reduction in well-paying jobs, what will the convergence of these factors be on retirement plans of those counting on real estate to carry them into their golden years?
I think this is a really important question, and I should note that economists differ on this, the effect of immigration and the like. But I'm in the camp that's concerned about baby boomers who are sitting on homes that they hope will fund their retirement, because there is a scenario in which there's this whole cohort that is not selling their big home. Normally, they all sort of downgrade to something smaller and move. They're sitting in them now. They're not downgrading. And the question is, are there people willing to pay the price they expect to get? And that demographic question is a real one. Immigrants tend to be lower income. Younger people are lower income. We know that there's a wealth disparity. I would worry. If you were in your 60s, 70s, sitting on a home that you count on for retirement, my advice would be think about selling it at these robust prices and finding a place you want to live.
All right. We got to take a quick break, but we've got more of your questions and this one. What single issue could make the housing landscape we see today change in a dramatic fashion, one way or the other? Well, welcome back to The Bottom Line. On house prices tonight, Patty, Jim, Preet, and Amanda are all here. Preet, you get the first question. Dawn Purchase from Ottawa. I'm interested in buying a condo for retirement. However, I don't understand why condo fees can range so widely. You and me both, buddy. What's the answer?
It's a function of the amenities. So if you have a swimming pool, a bowling alley, concierge, a home theater room, the condo maintenance fees are going to be quite a bit higher. And also, I would warn people with pre-construction condos and they have an advertised maintenance fee. We're finding that those maintenance fees can double in the first 3 to 5 years. So make sure to budget for that.
Okay. Jim, you get this video question.
Will the recent drop in lending rates just cause more Canadians to overborrow, causing a future crisis to be even worse?
That's a worry a lot of people have.
Short answer, yes. There's no doubt about it. Lower interest rates means people can afford a bigger house and they're willing to pay for it. And that's, in a way, a diversion of the stimulus effect that we want from lower interest rates. We actually have a weak economy and need for lower interest rates, but we want it going into real production rather than house inflation. So it is a worry, and it's one of the reasons we need other forms of stimulus in our economy.
All right. Patty, this one from Twitter, Steve Mantis. What effect has the shift in income inequality in Canada had on home ownership?
Well, presumably it's squeezing lower income Canadians out of the housing market, although we don't see that in the home ownership rate, which is close to 70%. But I think a symptom we are seeing is recently there's been a burst in construction of apartment buildings. We haven't seen that for years. So in Toronto right now, there's 21 buildings under construction. 2 years ago, there was only 12. So I think this may be a sign that people can't afford housing, so it's back to renting in a big way.
So there has been a burst, at least somewhere.
Yes.
All right.
Not a bubble, though.
Right. Amanda, Richard Spittle from Vancouver has this on Twitter. If the bubble bursts, will the economy be worse than the 2007-8 crash?
Absolutely not. Nobody thinks so. That was a global phenomenon. If the bubble bursts, it may be painful. It may hurt our economy, but absolutely in no way like that recession.
All right. Quickly from each of you, what single issue could make the housing landscape change in a dramatic fashion? Patty.
Higher interest rates, not happening anytime soon.
Okay. Jim.
Canada-wide recession, a lot of people will lose their jobs and then lose their houses, possibly.
Preet.
Jobs.
Jobs.
I'm watching inflation. This level of stimulus, inflation generally follows. It goes to Patty's point. It's higher interest rates, but I say nobody expected the Spanish Inquisition.
They didn't.
The Monty Python quote.
And I tell you, it was a shock to all of us. All right. Thank you all. It was great. And welcome to our Bottom Line Web Extra. Patty, Jim, Preet, and Amanda all here at the table with us. We got a couple of extra questions that we didn't get to on the televised program, so here you are with a Web Extra on Bottom Line. First question comes from Kincardine, Ontario. Thomas Shield. Does the Bottom Line think that the big banks, with their large exposure to mortgages and house-related debts, are presently a good investment for a retirement portfolio? Would you buy bank stocks right now on the perceived cusp of a faltering housing bubble, or would you wait? Patty.
Absolutely, I would buy them right now, and I think they form a bedrock of a retirement portfolio. And actually, right now, they're kind of on sale because over the last couple of months, they've been under downward pressure. But if you look at the Canadian banks, they are well capitalized, they're strongly regulated, and they are prudent lenders. And in addition to that, right now, the average yield, dividend yield on the big five banks is a juicy 4.2%, much higher than interest rates at these levels. So am I worried about the impact of a crash in housing? First of all, I don't think there's going to be a crash. And even if there were, if house prices, say, fell 10%, there would be an impact on banks. Consumers would be more cautious, but not a big impact. So my answer is, short answer, is yes, buy the banks. They're part of your retirement portfolio.
You agree with that, Preet?
Well, listen, full disclosure, I'm an indexer, so I don't pick any individual stocks and try and figure out what's going to do better
There's a lot
than...
of banks in the index.
There are, but I own them all, right? So I don't have to worry about that. But what I would say is, because the banks have such exposure to real estate, if there was a downturn, it probably would be relatively short, maybe 5, 10 years, something like that. You might see some softness, but over the long term, which is how you should always think about an investment portfolio, they're going to continue to be a big part of the economy. And certainly, I wouldn't be against buying banks. But again, I'm an indexer. I don't try to think about these things too much.
Never thought of you as an indexer. But now we will.
He knows so much. That's why he's an indexer.
Yeah.
Yeah.
He does know a lot. You're really promoting him tonight.
It's true.
Checks in the mail, Jim.
All right, here's your question, Jim. Comes from Vancouver, Bill McGrath. Should the federal government get back into the business of subsidizing housing development for lower income Canadians, people on social assistance, on disability, and the working poor? Thanks for picking up on this issue. The situation here in Vancouver is desperate.
I'm so glad we got that question, Peter, because, we talk about housing prices and everyone's thinking, well, when should I buy, when should I sell? We often forget a huge number of Canadians don't even have that option, let alone buying a property and getting the down payment. Many of them can't afford even to rent. They estimate that about 15% of Canadians have what's called core housing need. That is to say, they can't buy even a rental or rent a small apartment for less than 30% of their income, and that's obviously worse in a place like Vancouver or Toronto. There's 300,000 Canadians homeless. So I actually think it's a great time to get back into social housing. That includes public housing, NGOs and community housing. Housing co-ops are a very effective form of low-cost housing. Among the benefits, you're obviously helping people who need housing get it, but you're also putting some sort of damper on the house price inflation that you're seeing elsewhere in the real estate market and creating jobs in the construction. So I think it's an excellent idea.
Amanda.
I do think, I'm glad we got the question too, because we can get kind of consumed with this idea of sort of a certain swath that's buying and selling and investing. And we need to support a whole group that can't necessarily own homes. I don't think that direct support for homeownership is the way to go. Federal support for building housing stock that is available to people that can't afford to live in a house is great. If you want if you want to subsidize housing, I believe, and I think economists would back it up, you should do it directly. So vouchers to people rather than giving them a place to live. But we can kind of quibble over how you get there. What we know is that even in our biggest cities, even apartment stock is not what it should be for people that can't afford a home to live in. And then you get into people who have trouble even renting an apartment. So this is a social question. It's not going away. And by the way, it used to be that we had this conversation about, young people, people at the lower elderly people are going to increasingly need this as well. So it's going to be a conversation we're going to have.
All right. Thank you all.
Thank you.
A couple extra questions for this special Bottom Line Web Extra. Hope you enjoyed it.